out to your FOMC meeting. It is on behalf of Maverick Currencies. I'm Corey here with you today.
Do you want to be a professional trader? Maverick Currencies is the oldest US-based Forex and crypto prop trading company that will pay you for trading with our capital. Trade our capital and keep 70 to 80% of the profits. We are looking for traders just like you that are hardworking and motivated. Click the apply link on the top right of this video to see if you have what it takes. That link takes you to a 4-minute video that explains the trader position available, and you read a list of FAQs that answer pretty much all the basic questions you have at this point. After watching the video and reading the FAQs, if you're interested, fill out an application, then you'll watch the full-length recruiting video, and then schedule an interview with one of our traders. Are you our next trader?
Nice to see all of you, and let's jump into it. So a few different things that we're going to discuss here today. First, kind of our game plan for this meeting, and if we come into Forex Factory, we can see a couple of different things. And maybe I'm going to take a step back. I'm going to go to yesterday. Yesterday we had CPI data, and of course the Fed has been laser focused on inflation. The year-over-year CPI came in at 3.1% as expected. The monthly CPI came in at plus 0.1. So inflation has fallen back. It's still at 3%. Of course, it's 1% above the Fed's target of 2. It certainly has come back. The trend has been going lower for some time. Stocks have been rallying, because of that, and so on and so forth. Now, the question is always not what has happened in the rearview mirror, but what is going to happen in the future. So we come into today, and as we look at today, we've got the Fed meeting. And the Fed meeting here is not expected to have any change to interest rates. And that's almost a foregone conclusion. There's a 99.9% certainty. The Fed's not doing anything today. They're going to leave rates unchanged. If we were to look at a graph of this, you'll see that that's what they've been doing. So I always say that when the Fed changes rates, it goes in cycles. If you go back to 2016, 2017, there was a rate hiking cycle. And then there was a pausing cycle for a few meetings. And then there was a rate cutting cycle. And then there was a big, long pausing cycle. And we've been in this huge rate hiking cycle, right? It's a cycle because it's not just one. The Fed doesn't cut once and then just pause for endlessly, right? It cuts once, it pauses the next meeting, it cuts again, it pauses, it cuts again, it cuts again. So these things go in trends, and the Fed they always say they're data dependent, which means essentially they're always behind because they're waiting for the data to show something and then they're reacting to it. And sometimes they're, kind of foolish. I don't know what better term to use than if you look at inflation. Inflation had already been up above 7% before the Fed ever started to hike rates. Why is that? Why would they wait so long if they're data dependent? Because they kept saying, "Oh, well, it's transitory. It's not going to stick. It's just a mirage. You're seeing inflation numbers, but it's not really here to stay. So we're not going to react to it." And they were so far behind, they didn't even start hiking rates until inflation was above 7%, which is a gigantic policy mistake. And so since they made such a big error back in 2022, 2021 cycle, the question now is, can they afford to screw up inflation a second time? And if you look at it from the Fed's viewpoint, the Fed has two mandates. Employment, which is full right now, so they want to keep full employment, and price stability. Well, price stability is what they screwed up, right? They did not keep prices stable. They let inflation go unchecked for too long, and it became entrenched for a period, and it fed off of itself, and it was just a gigantic mistake. So since they screwed this one up, my bet is that they're willing to sacrifice this to not screw up this a second time. They're willing to have the economy slow. They're willing to have some negative things happen in terms of people losing jobs and so on, but to keep inflation in check. You can't keep making the same mistakes, and that's where they could open themselves up to massive criticism, is if inflation really became another problem, became entrenched again, they didn't do enough to solve it, so on and so forth. And that's where their fears lie. So if you were to think about it from the Fed perspective, they are far less worried about the economy and those things as they are about inflation. And it's important to understand where someone's fears are, what they're most nervous about, is part of essentially the way they're going to behave, right? When we talk about personality and so on and so forth, well, you could argue that we're all free to make our own decisions, but to a certain extent, we're programmed to act certain ways in certain circumstances, right? And I think in this case, they're even on record as saying that. Look, price stability, getting inflation under control is our number one goal and objective. Now, what the economy has said is, well, they're doing it, right? Inflation's down now to 3.1%. The issue is solved. The market's even pricing in multiple rate cuts for next year. Well, the only way the Fed's going to start cutting rates is if something gives. If prices are stable, inflation keeps coming down, employment is strong, and the economy's chugging, why would the Fed cut rates? So the question is, what if the market thinks that there's multiple rate cuts coming? Then first, they think that inflation is solved. They think that inflation is not going to come back up. They think that's a done deal. And second, they must think that the economy or something is going to give some ground to where the Fed has to react and solve, this side of it, employment, people start to lose their jobs, whatever. They must think that this is the issue. And that's what the markets are pricing in right now. If you think the Fed's going to cut rates 4 times next year, you must think there's a stumble in the economy, that employment becomes a concern and so forth, and that inflation is under control. I think the market is overestimating the inflation side of things. And again, I think the Fed's going to be slow. So even if the economy slows and there's some unemployment that comes through, I don't think the Fed's going to be in a massive hurry unless they're really, really convinced that inflation is in check. So I feel like the market has that wrong a little bit. Now, someone might say, well, Corey, why are stocks booming? Why is risk on? And we've been talking about this the past few weeks. We are in risk on mode. We are fully, equities flying higher. Things like Kiwi and Aussie have been performing well. These are risk on currencies. Things like yen and US dollar and some of these others have underperformed, which is what you'd expect in more of a risk on environment, right? So, why is that? Well, I think this has more to do with seasonality, personally. I think that there's a little bit of some of this happens late in a year. The stock market's up year to date, and people will lose their job if they underperform by too much. And so part of this stock market rally, this huge boom that we're seeing higher in stocks, I suspect, this has been a great run from the end of October. That's a huge move on a percentage basis. But is all of this buying happening because people really believe in it? Or is some of that buying, at least some of it, a chase and saying, well, we can't underperform. We have to make sure that if stocks are going to go higher, that we're participating in that. If I underperform and I'm a money manager, I might lose my job. They'll find someone else to manage the money and so forth. And that's what happens late in a year, is you get a lot of potential for chase type of dynamic. Now, I'm not saying that's all of it, but I think that that's at least some of this rally that's transpiring. And oh, by the way, we still have half of the month left. We go through the Santa Claus period, the week after Christmas and so on, which is historically can be bullish and so forth. So I don't know that this thing is done just yet. I mean, there could be a little bit more room to go here on the upside. So if I come in, and I was looking at a few of these currency pairs, but some of our preferred, our favorites, are still somewhat in alignment for upside. You can see the Kiwi here. It's pulled back a little bit in recent days, but I mean, this has been a great run again since that late October. So see the correlation as stocks bottomed here. That's right around where the Kiwi bottomed out. That's right around where the Aussie started to really take off to the upside. So if we come over to the Aussie, very similar chart. Late October, right along with equities and moving to the upside. So those have been some of the outperformers. Now, CAD has been an underperformer. We could go into the actual CAD chart against everything. Let's do that. This just shows you how the CAD has performed versus every other currency pair out there. And we're currently in a little bit of a low base pattern. Now, this has more correlation to oil prices, which have been terrible the past couple of weeks. CAD is a tough one for me. I did a currency recap on Monday, and I think it's going to be choppy. I never chase momentum. One of my rules is when you're in a downtrend, you don't buy breakouts, you buy pullbacks. If you're going to buy in a downtrend, which always isn't a very good idea. But if you're ever going to do it, you buy the dip. You don't chase the breakouts, because breakouts tend to not have a lot of momentum. There's just too many dead bodies, too much overhead supply. So if you're playing CAD, it would be in these type of pullback modes. If we go to the US dollar chart, you can see again that correlation where late October things really turned, right? This is where the S&P bottomed. This is where risk on rally took off, and the US dollar has been working its way lower since then. The next couple of weeks, we could see further deterioration in the dollar. We could see further risk on. I don't know that that carries dramatically into the next year or anything like that, but I think it's one of those things where we could start to see a little bit more underperformance in US dollar for the rest of this year. And then as the calendar tips, maybe the dollar starts to bottom out. Maybe you start to see stocks pause and some of those other things. Again, it's weird that things work off of the calendar, but remember, it's the emotions of individuals that are managing large amounts of money that may have their job on the line, and they're going to do things like chase and a variety of other things. So we're going to look to trade the US dollar pairing. If you look at the recent chart, this makes it a tough one. I mean, there's just nothing happening in US dollar overall. We've been basing. The overall trend is lower, and seasonality says the dollar can go lower. So let's come into a little shorter time period, maybe a 12-hour chart. You can still see that basing, kind of a little wedgy type of pattern here, a little bit of a wedge, if you will. If we look at it on a shorter term basis, the 4 hours, same thing. It's kind of this choppy pattern, and it just shows that same pattern, but in a little more spread out fashion, right? Here's the higher lows. Here's the equal highs, and do we break this way? Do we break that way? The Fed can fuel that. My instinct would be to just, hey, trend and momentum and seasonality and some of those things are working lower. Let's err on the side of trading USD with the trend and playing it to the downside. So as far as pairings to go against it, you probably don't have to overthink it too much. These would be some candidates. And then, like I talked about on Monday's currency recap, the CAD is more of, I would call it um, a speculative idea. It's not a certainty that oil has bottomed. It's not a certainty that a lot of these things, are going to transpire. It's my instinct to think that CAD is going to have a little bit of a bullish correction. Not a lot, but a little. So maybe an ABC style pattern. It's already rallied a little, it's pulled back a little right here, right now. Maybe it can go a little further, but we'll see. Let's look at a few of these charts together and make sense of it. So if I come back to our dollar pairs, let's go first look at a couple more of the obvious candidates. Kiwi US dollar, a little bit of a short-term downtrend. Aussie US dollar, kind of down to consolidating on that 4-hour chart. Dollar CAD in a sideways range. Could go either way. I mean, that's about as tight a trading range as you can get, right? You could break these highs and go higher. You could break the lows and go lower. In this case, dollars listed first, so if we short this pair, if we short it, we're playing dollar to the downside, CAD to the upside. If we buy this pairing, then we'd be playing dollar to the upside and CAD to the downside. But you can see that tight consolidation. Again, this is why I said today's meeting is going to be a little tricky because US dollar has a lot of these sideways range style trades in most of its pairings. Let's click through a couple others. Pound USD, pound has been trending lower in the short term. Again, we're only on a 4-hour chart. So last couple of days it's pulled back. Euro has been trending lower the past few days versus the dollar. Swiss franc sideways, and dollar versus the yen. Again, dollar trending a little lower versus the yen, but I would call that a sideways pattern as well. I'm inclined to look a little closer to dollar CAD. And this is, again, it's a bit speculative in terms of the pattern and whatnot. But let's see if we have anything that gives us a little bit better, maybe risk reward probability. I mean, I don't know that I can actually trade this pairing. Those charts just look so horrendous. Let's go back to Aussie or Kiwi and do the same thing. I'm just going to kind of click through here and see if we have anything a little more worthwhile. Aussie USD on the 30-minute is in a little bull pullback, and the 1 hour, same thing. I think that's probably our candidate. Let's click to Kiwi USD, and similarly, that has some prospects there, but I think I like Aussie a little bit better. Here's the 30-minute chart. Here's the 1 hour chart. And in both cases, at least you have something. Now, granted, I know we're operating still in a sideways somewhat range, right? But we got some push to the upside. So if we were to do a comparative of the pivots, well, we made a higher peak than prior peaks. As we pull back, we could easily make a higher low than prior lows, which is the dynamic of a rally, right? In a rally, you make successive higher highs and higher lows. So what we're basically suggesting is we think it's going to set and establish a higher low here. That Aussie will rally versus the US dollar. Now, the Fed meeting is going to have something to say about that, no doubt. This thing is going to move in an instant here. We're about 8 minutes away from a spike in this. If it breaks down, we've got no trade. If it breaks higher, well, then we've got an opportunity. And so what I would typically do is place a buy limit, but not execute the order. Just have it standing by. And I'd put in my limit price at what I was willing to pay. And maybe you're willing to go as high as 65.75 or something like that. Just have it ready to trigger. And then I would have a sell stop attached to it for my protection. And you don't need to risk too much. I mean, you could really have a relatively tight stop here and not risk a whole lot. I mean, I think it could be in the 60s. Let's call it 63 or something. And you're risking 12 pips. Okay, 12 pips is your risk. Now, because this is Aussie USD, it's a very low cost currency pair. It's a low priced currency pair. The pip movement is going to be less than if you were trading it versus something like the pound, for example. If we were trading pound USD, we'd have a trade that was risking 25 pips or something. But on a percentage basis, it's going to work out very similarly. Now, this type of setup and idea, what will often happen on the announcement is this thing will spike above, show us some energy, show us some bullish reaction in Aussie. It would basically be an upside reaction in Aussie. It'd be a bearish reaction in USD, and that's what we're looking for. So we'd like to see this chart kind of spike up. You probably have spiked above the price, but what happens, you'll see this shoot up and then it'll just chop around, and all it would take is just some little choppiness for a couple of seconds will trigger your order. And the reason, again, it's not a live order, but the reason I would have this order ready is I don't want to go in and have to punch in all the numbers and figure out where my stop loss would be and how much risk. I can't be doing that after the news announcement. And basically, in the moment that I know I want in, I want to have an order ready for me to just hit the button and I'm gone. I'm in the trade. My stop loss is intact. Everything is ready. Sometimes I'll put this a little bit higher. I mean, we're pretty close to current prices. We're not giving it a lot of room, but there's still a very good chance that this whole dynamic can get filled. What we'd probably be thinking along these lines is, at least a push back up here towards resistance. At least a push up here, which is, 23 pips is where I've got that line drawn. 23 pips above current prices, which is basically a 2-to-1 reward to risk ratio. I think it could go higher than that, but this would be the type of dynamic that I'd be looking at. Again, it trades more with the dominant trends that have been intact. It does trade the seasonality. The thing that I dislike about this is that it does go against my overall viewpoint for the Fed, which is that at the end of the day, they're going to fight inflation and they're going to continue to spread that message, which that messaging theoretically would get the US dollar rallying. Well, if the dollar rallies, this pair is going to shoot this way, and we're just going to say, well, unfortunately, we don't have much to work with here. So I'm more laser focused on, let's see if we get a bullish reaction in the Aussie, a bearish reaction in the US dollar. And if we do, we could transmit the order and be ready to go. So I've got some things ready on my other screen here, but feel free to do your thing on your side, whatever you feel most comfortable with. That would be the type of idea. So I'm going to clear some of this off. Maybe we'll take a little screenshot of the idea, the 12 pips of risk and possible entry. But the idea would be to buy maybe a few pips above current prices, but somewhere around this mode, stop loss down here below, and you're not risking a lot. Now, with these Fed meetings, there can be a lot of fake out move. There can be, your knee-jerk reaction can be a spike up and then it just collapses back down. A spike down and you just rally right back up. Or a spike up, it drops a little and then it spikes again. There's all sorts of little volatility moves that you've got to deal with. So I don't just naturally hit the execution button immediately. As soon as I see it go up, I assess what I feel like. Sometimes it's such a dud that I'm like, well, I'm not going to follow through on this. There's no energy, there's nothing. That happens sometimes, which means, the Fed meeting comes out and you almost can't tell from the chart that anything has happened because the price doesn't jump, it doesn't move, there's no volatility. And in those circumstances, a lot of times we won't trigger the trade, um, given that it's likely to be a lot more choppy. Every once in a while, we'll get triggered into something and it'll go to the stop pretty quickly. I mean, that's pretty standard. If this trade doesn't work, it'll stop you out quick. If it does work, you can be in it for a few hours or more, that possibly this thing could be growing a big profit into tomorrow or what have you. So we're not risking a lot, but that would be the overall idea here in terms of trading Aussie USD. Good question. The only reason I picked Aussie USD over Kiwi USD was on this 1 hour chart. See how Kiwi's still below these moving averages? Aussie's a little more healthy. See how it's above the moving averages. See the upward slope in this moving average on the 1 hour chart. So a little bit more sign of strength, relative strength in the Aussie compared to the Kiwi, and I like that. We want those types of they're little things, but they're meaningful. We want to be in the things that are stronger. The things that are stronger tend to get stronger still. That's how trends and momentum work in the shorter term. So we're moments away here. You should be seeing a reaction within about 30 seconds or so. So I'm going to move my cursor so you can see that candle and just watch for the burst. There it goes. So see that burst, and right off the bat, Aussie with a huge spike up versus USD. So you could adjust your price a little bit, maybe go to 65, 80, a little bit higher, pull your stop loss up a little bit. This is the danger of not being in already, is that we had the exact right outlook and it's taking off without us. So this is a circumstance where there's a lot of energy, and that energy was exactly the trade, but not this is not going to be actionable. I mean, it's already gone to the target. It's absolutely positively taken off. You're going to see this in all the US dollar charts. So by the way, I'm not in the trade because, it just reacted so quick. But look at the US dollar. It's tanking right now. US dollar, big drop. Big drop versus the Swiss franc. Big drop versus the CAD. Euro, big rally versus the USD. So in every one of these charts, if USD is listed first, you can see the big drop, or if it's listed second, you can see the big drop in the US dollar based on the first currency listed with its huge rally. So we're getting a big reaction to the downside. Fed says that growth has slowed from a strong Q3 pace. So they're talking about some of the economic weakness. The market's taking that and running with it. It's saying, hey, the Fed they really are going to cut rates. They're already talking about a slower economy. They're already putting some of these things out there. So I would say that that's, kind of dovish messaging where they're talking about inflation has eased. It remains elevated, but it's eased. They're not signaling a more hawkish tone, a tone that says our first goal is to fight inflation. Now they may feel that way, but I would agree with the market in that their messaging is a little different than what it has been. Now, that doesn't mean that they're about to cut rates, right? It just means that their messaging has softened. And what the market's suggesting in terms of its reaction is, hey, the Fed is saying that they've done good work with inflation. They're saying that they're concerned, they're aware of the economy slowing. They're pointing out some of these things where that's a different messaging than to say we need inflation to come down. elevated. We've got to use all of our tools at our disposal, right? It's a softer messaging. It doesn't necessarily mean that they're poised to start cutting, but I would agree with that. So you can just see, I mean, huge reactions, big volatile reactions. It shot up in a hurry. This would be a trade where either you were in before the announcement or you were brave enough to buy after it had already shot 30 pips, which can be a big problem, but in this case it would have been a reward because it's gone 30 more. But at this point, I don't think there's anything that I can really do to take advantage of this. Good question. Is this a little bit of an exhaustive move in the US dollar? Meaning, can the US dollar, is this its exhaustion low? Well, let's go back and look at the dollar pairs. Let's go to the daily, the long-term chart. And I'd say from this chart, it doesn't show that necessarily. This chart, we're still in the consolidative phase, and it's just starting to break down again. So this would argue not that it's an exhaustion low, that more, hey, we're gonna be poised to break down here in the coming days. So my thought would be that, it might be done for the day. It's moved a lot, but doesn't show me that it's done overall. If anything, it might be poised for that next phase of another leg lower. So I don't see that within today's price action anyway. Look like, more of a breakdown starting to happen within the consolidation, but even within that, you're still inside of the consolidation that's been taking place. So, nothing too kind of, doesn't look like a finish line, just looks like more of the same. It's been trending lower, starting to break down, and maybe starting to trend lower again after a pause. All right, we'll leave it there. Thanks everyone for joining us. Sometimes markets move quickly. They have a lot of energy, and that was certainly the case today. We were hunting in the right spot. The 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 bad side of this, I mean, if you were looking at it as we didn't lose anything, right? But the bad side of it is it could easily have given that little burst, and then what you'll sometimes see is just a wave of selling that would have come down and filled our order and then taken off. I mean, there's certainly an alternative scenario where we could have gotten triggered into this trade quickly and then it took off in our favor, which would have been a lot of fun. In this case, it just jumped and it did not look back. So, that was one where you either had to be in or you had to be willing to really chase some momentum. And that's not my bread and butter approach. So thanks everyone for joining us. We'll see you next time.